Well, good evening, everybody. Welcome back. Tradeway TV here on YouTube, Facebook for our friends out there. I am your host, Blair Nightingale. This is Market Monday. Tonight, going to cover something. If you are a trader, you must know about our topic tonight. If you've been trading for a little while, no doubt you have heard of this specific topic multiple, even many times, because for traders right now, this is dominating market direction, market sentiment, market expectation. Everything that's happening really in many ways is connected to tonight's topic. It's actually very simple what we're going to cover tonight, but very powerful. The Federal Reserve, we're going to break this down a little bit. We could go into a heavy deep dive on what it is and how it came to be, but I'm going to keep it light for us tonight because I just want to give you what I believe is important for us to know as traders. We don't need to get lost in the weeds on what it is, but helping us understand what it is and how it'll impact a short-term outlook on stocks for us trading and a long-term outlook on stocks for those investing or doing some long-term option strategies and things like that. So it's good to know what the Fed is and what it's doing. I also think this is just an important thing for us to know. Yes, in the market, specifically, obviously the stock market, but really just in terms of what's happening with the economy, with money, because it's actually very, very influential as to where we're going. And I think it's important for folks to understand the activity of the Fed because it's actually really powerfully, you might say, affecting the economy, affecting our national, I'm going to say, stability in some ways. This is certainly the question that we need to wrestle with a little bit because I'm going to show you some stuff tonight. I'll have some visuals for you where you can see the Fed has really impacted the condition, the economic condition of the United States over the last particularly 15, 16 years, really since the financial crisis in 2008. They've been around a lot longer than that, but really since the financial crisis in 2008, it's deeply, deeply impacted where we are as a nation. So I want to talk about that tonight. Of course, if you're joining us for the first time, please go ahead, drop your name in the comment section. If you have any questions as we go along, I'd love to hear from you guys there as well. So you can drop that right in there. First things first, though, I always like to go in and just take a quick look at the S&P 500, at the markets. Remember, here at Tradeway, we're not looking primarily at the long-term outlook of the S&P 500. We do spend time on both. All right, the majority of our students are really looking at a shorter term swing trade, 1 to 2 days to 1 to 2 weeks in most cases. So we're looking at the markets in a much more technical way, a much more short-term way, even though, yes, we do look at the long term as well. Primarily, we're looking in the short term. I want to talk about the Fed tonight in light of both of those things, okay? But that said, we've got a pretty clear level here that we've rejected at again today. And again, in the short term, 4,000 seems to be holding pretty well. So we're really in this wedge pattern. We're making lower highs in here. We're definitely seeing 3,800 holding up over this last few weeks. It's bounced and made a pretty nice push up there. But we're looking for a clear breakout of this wedge, because you'll notice we bounced at 3,800, hit historic resistance, and began to drop. That's what we would expect a wedge or even a downtrend to do, right? But it actually reversed and came right back up to that high, right? Right back up to 4,000. Part of the reason we had that volatility last week was the Fed, right? We've got Fed, and news can change patterns pretty significantly. So the Fed comes in, and we have to be aware of what they're doing, and primarily, I would say, when they're doing it. Because for you and me as traders, we are definitely wanting to be aware of those days of volatility, what they're doing, what the outlook is. In some ways, even though we're going to talk about the Fed tonight, we want to learn what they're doing. And then at times we kind of just want to ignore them. Depending on the kind of trading we're doing, we just want to ignore them. We don't want to give them too much attention, but they're certainly a huge part of the news cycle. Ruth says hi in the comments there. I'm going to pop you up there, Ruth. She's joining us on YouTube with our YouTube friends out there. And Ruth, I saw in the comments there, you're just asking about a replay. So you can clarify with me if I'm misunderstanding what you're asking. Obviously, this is going to be recorded and put right there on YouTube so you can watch it. Everything we've ever done is on there, so you can go back and you can watch that on YouTube. So again, let me know if I'm not understanding exactly what you're asking for there. But first of all, I say the Fed. Well, the Fed is for the Federal Reserve. And like I said, we're not going to get bogged down in the details too much because you don't really need to know all the history and all the technicalities and ins and outs of what they do. There's just a few major things we need to know. And the biggest thing is that we need to know that they have certain activities that really impact the stock market. So a little bit of a stock market lesson here. Remember, the stock market is what we call a leading indicator. Now, that's a fancy way to say all the minds on Wall Street, they're risking money in stocks. Obviously, we have options and different kinds of investing instruments, but stocks in particular, they are looking 6 months out and going, what's the outlook? They're not just investing on what is today, they're investing on the potential growth of tomorrow. They want to project out and go, hey, does this stock, does our market, does our economy look like we think it's really going to grow over the next 6 months or not? Is there a sector within the economy that we think is going to grow in the next 6 months, while maybe we think some of the other ones are going to continue to shrink, right? This is the job they do. Now, what's amazing for you and I in 2023 is that we can go out and simply look at a stock chart, right? And we can get a visual assessment. We can look at the chart and just say, what sector is doing well right now? Where are investors putting their money? Peter Lynch said there's no better tip. There's no better tip on a stock than when people in the company are putting their money into the company, right? And actually, we do have software where we can go and look at insiders in a company actually investing in their own company. Obviously, it would be nice to know if we had a CEO or a CFO or a C-level manager that's selling off all their stock. The banks that we've been talking about the last few weeks here on Market Monday, obviously we had some major bank failures here in the United States recently. Well, I'm seeing the articles popping up daily now where the high-level managers of the banks, Silicon Valley Bank in particular, sold, I want to say hundreds of millions, but I don't quote me on that. I don't know if it's quite that high, but they sold millions for sure worth of stock, knowing that this bank was going downhill. Obviously, they wanted to get their stock cashed in before the bank went under. So that's calling for some scrutiny for sure. The point is that those insiders are buying and selling. We can see that now at the end of the day, when the market is confident over where the economy is going, we're going to see the indexes rise, particularly the S&P 500. We're going to see that rise. When they are overall not confident in where it's going, they're going to manage risk, liquidate the position, move it out of the markets perhaps over to safer assets in times of what we call contraction, meaning our economy is shrinking, our GDP is shrinking, things are going down. So these kinds of things are happening. We don't need to understand all the economics of it. You and I just go and we literally look at the chart itself, and it can tell us, the trend of the chart can tell us what they're confident for. Now, obviously, it's not a crystal ball. It doesn't tell me exactly where the S&P is going to be in a month's time. But it is, as I mentioned, a leading indicator. They are going, can we be confident about where we're going to be in 6 months? If yes, they're going to invest. If not, they're going to sell. That's what's going to happen. So if we're seeing the market trending down, they're not expecting growth in that 6 month time period. And there's no rule that says Wall Street is specifically looking at about 6 months. It's not like it's that exact of a science, but they are projecting out longer term into the future to see. So you and I get the opportunity to look at that. Now, what starts to come into the conversation at that point is something called the Federal Reserve. Okay, the Federal Reserve. Now, you've probably heard me or some other coaches, or just even in the news, the Fed. If you've been interested or following the markets at all, you've heard the Fed. So, what is the Fed? How does it impact us as traders? Because it certainly does. It provides some difficulty if we don't know how to manage that. It provides some opportunity if we do know how to manage that. So the Fed ultimately was created in 1913. Okay, this is, I think, December, actually, 1913. It was actually, the bill was passed, it was created. And what it was the government said, let's create this federal board to manage, monitor, right? The monetary system of the United States, money, banks, lending rates, all that kind of stuff. They get the power to monitor that. Now, it's a quasi, you could say, government agency. It's not specifically, it's not as explicitly governmental as, say, Congress or something like that. It's certainly not elected officials. It's appointed officials. Okay, they're presidentially appointed. Currently, there's a chair. This is who will typically speak for the Federal Reserve. Jerome Powell is the chair right now, so you'll see his name as well. And the big thing is that when he comes out and talks, traders are listening. They want to know, what is he going to say? What does he think for the future? Because he and the other members of the Fed are able to pull certain levers in the economy, which I'll explain in a minute. And this is what's important for us as traders. Who sets the interest rate for how much money is going to cost us, right? Now, ultimately, banks, when they have surplus reserves, can lend. I mean, they can always lend, but there's something with surplus reserves where they can lend to one another. And the Fed sets this rate, the federal funds rate. They set this rate, and banks can lend one to another. And this actually trickles down, right? This rate actually trickles down to interest rates that we see on all kinds of things. The one big one that's come up quite a bit this last 6, 8, 12 months is interest rates on mortgages, home loans, right? Interest rates on home loans, every time the Fed has pulled that lever and changed interest rates, it has changed what's happening in home loans. They can change credit cards, bank loans of all kinds, business loans, interest rates on a car, all kinds of stuff like that is changing. And the Fed has the ability to do that. Now, they have multiple tools. They have different things. And like I said, we could go deeper into the nitty gritty of how these things work. But for you and I, we know Wall Street is watching the Fed because they have power, right? Now, some people feel like the Fed has too much power, that it's controversial in that they do things and they meddle with the economy in ways that maybe aren't handled as well. I remember during COVID, us coaches here at Tradeway consistently heard Jerome Powell talking about how inflation would be transitory. The market was getting a lot of money pumped into it, which, by the way, is another tool that the Federal Reserve has, which for a lot of people is fairly controversial. They can do something called quantitative easing, which essentially is they're printing money and they're pumping it into the financial system, right? They're pumping money into the economy to what? To stimulate it. They were trying to do that during COVID, right? So they lower the interest rates way down. People will spend more money when it's cheaper to borrow the money. Would you rather borrow money and spend it if it was, say, 1%? Or would you rather do that at, say, 6% or 7%? Well, obviously, we'd rather have it at cheaper money, right? It's almost free money when it's near zero. And the rates, the federal fund rate that they control that trickles down to you and me was near zero. Now, obviously, we weren't getting 0% on credit cards, right? That's not how that business model works, but it does ease a lot of those interest rates. And we saw the real estate market, for example, screaming hot as people all over the country were relocating, right? In COVID, a real shift in the demographics there. And interest rates very, very low, very, very low. It created a real boom in some states, right? That was the effect of that funds rate. But they also print a lot of money and they purchase things with that money, right? The Federal Reserve can purchase treasury bonds, government debt instruments, bonds, notes, bills, all kinds of stuff like that. They're actually buying billions of dollars of this because it stimulates the economy. So not only are they purchasing things, they're making money cheaper to get so that stimulates purchasing. You and I, as the consumer, are able to go out and borrow and spend. So the company that we spend with makes money and they pay their employees and their employees make money. And then those employees go and they spend money. And this is how the economy turns around, right? And it can stimulate it tremendously powerfully. Now I'll go over here and we go back to this chart. That is ultimately, let's go here. That's how this on the left side, we'll go ahead and get rid of that. That's how this happened, right? Now that's May 20. So obviously March 20, right, was down in here. And then boom, we just absolutely exploded. I said this many times during that season. Are we in better shape as an economy than we were before COVID? If you remember, we had one of the strongest economies we've ever had prior to COVID. And then the entire economy shut down, okay? Shut down, and yet the market was exploding. Why? Well, in large part because the Fed cut interest rates down to zero, money was fast and cheap, and they began buying those assets that I mentioned earlier. So they have the power to do this. Well, now we hear Powell at that time saying, well, we're starting to see inflation come up a bit. This is one of the reasons the Fed was created, to control employment, inflation, right? This is a big thing. We don't want inflation getting out of hand. Some of you guys out there, you remember the late 70s, early 80s, right? The interest rates at that point in time are just, astronomical, right? The federal funds rate is at about 5% right now. I've talked to some people who were buying homes and were homeowners in the late 70s, and they were paying double-digit percentages on interest rates. So we're not there now, but the Fed is actually in control of that. That's part of how they try to heat and cool the economy. Well, hearing all this talk about, inflation's transitory. And, a lot of people were very skeptical of that, to say, well, what makes you so sure that inflation's not going to get out of hand if you just continue to use new money to purchase things, bonds, instruments, as I said, and keep money really, really cheap? Are we not creating a bubble here? Is this really based on real growth, or are we creating a bubble here, right? That's really the concern that we've had along the way. And of course, we started to see inflation creep up. And then it hit 40-year highs. Haven't had inflation as high as it was since the early 80s. So what does the Fed have to do? The Fed goes, okay, we've got to stop buying and we've got to start raising the interest rates, right? Now, what does this mean? I see some good questions out there. I will get to that. So what does this mean for us? Well, you'll notice on the chart, where did it stop and start dropping? It stopped and started dropping when the Fed started raising rates. Now, I'm going to stop the share here for a quick second because I want to show you another screen. And we're going to go right here. I want you to see this visual, okay? Comparing the speed. Now, this is 6 months ago. Okay, so the federal funds rate is higher than it shows even on this chart. But you'll notice in this yellow box, this is the kicker. Okay, so the interest rates right now are not higher than they've ever been. Okay, they've been higher. I mentioned that just a moment ago. However, they are moving higher faster than they've ever moved, right? So I want you to consider this for a second. We had an unprecedented, right? We all heard that word. I can't even tell you how many times, right? During 2020, 21, we had an unprecedented economic halt. Just like that. Everything stopped. And the markets crashed. The economy crashed, right? The country crashed. And then they kicked it into high gear. And they went into, and I'm going to show you this in a visual in a second. You'll want to stick around for this. I promise you guys. This is eye-opening. Where are we going this year? Okay. I see a question in the chat that I'm going to comment on that, but I want to hit this first. Then we get massive stimulant. Now, what happens to, I used to listen to a trading coach who would say, what happens to a teenager when he's just flying high, right? Full of energy, but he starts to slow down and then just cranks a Red Bull, just drinks a Red Bull, an energy drink. Well, of course, he's going to get a charge, man. He's going to be up. Boom. And if he drinks another, boom. You know, eventually they don't work as well as they did. But what's going to happen when he stops? Right? What's going to happen when he stops doing that? He's going to crash. That's what he's going to do. He's going to crash. Okay? Well, that's stimulant. It was a stimulant season, right? They were stimulating the economy. That's what caffeine is, guys. It's a stimulant. Well, that's what they're doing, stimulating the economy, right? And there is a place for some of these tools. But when you see a crash like we got in March of 2020 because everything stopped, and then you stimulate, and you could say overstimulate, where many stocks went astronomically high, right? Tech companies, pharmaceutical companies, so many companies actually received a lot of government cash. And certainly Wall Street was feeling like they were having fat times and things went up. Now, if you were trading at that point, if you were investing in that point, you had the opportunity to see some pretty good returns, right? As long as you knew how to protect that as things have reversed some. Of course, that's true in all investing and trading, right? It's not what you make, it's what you keep. Okay, so that's very important. However, here's where I'm going with this, guys. If you've created an unprecedented bubble, and then out of what you did to create that bubble, the Fed, spending, printing money, keeping money cheap, making the economy heat up until it's too hot, and inflation is getting out of control, and it's hurting the American consumer, and it's hurting the economy. All right, now we're going to raise rates faster than we ever have. What does that set us up for? Well, that's what we're in the middle of right now, guys, because we're starting to see, and this is what happened with the banks in the last few weeks. When the Fed raises the federal funds rate, and I'm going to take you down here so you can see this picture here. You'll notice over here on the left, 2022. Now, that rate is not higher, as I mentioned, than many other points on there, but it is much steeper. Okay? It's much steeper than the others. Meaning, if I go down a little further, you can see it tracks the months since the hike cycle started, right? Before they go up and then stop and come back down again. Okay, so this is showing the comparison over time. And what's important here is that the banks that failed started to show that it doesn't work through the economy right away when the Fed raises rates. It takes time. It's not like the Fed raises rates and the next day things start to cool down. No, that cash that's out there, that momentum that's out there, it takes time for that to work through the system. which is what they're actually trying to do, guys. They're trying to make money more expensive and less stimulation so that things will cool. Now, they don't want to cool it too much, but they want to cool it enough to get inflation down. That's their job. That's what they're trying to do here. Now, the issue is that they don't have as much control at times as they would like to have. And when they're very aggressive with the funds rate rising, it's like hitting the brakes, right? And if you hit the brakes really fast, there's a bit of a jerking motion. And they're wondering, well, is the Fed going to break something in the economy while they do this? That's what we would call a hard landing, by the way. A hard landing is what triggers a recession. A soft landing is they get inflation back down, but they're able to maintain some economic health, right? The big thing is unemployment. Well, tech has been hit with serious unemployment, right? They've certainly seen a lot more cuts and contraction. So what happened? Silicon Bank gets affected by that. Now, we've done a whole episode on what happened there, so I'm not going to talk about that in detail tonight. But what I am going to say is it's starting to show what are the effects of these fund rates coming up. Fed says they're still going to raise rates again further into the year 2023. So for you and I looking at this, there's a couple things we've got to know. Now, I'm going to show you one more screen. So stick with me for a second. I want to show you one more screen because this is crazy. Somebody showed me this years ago, but it's updated and it blows my mind. I will put the link in the chat for you guys so you can go and you can look at it because it's pretty interesting. What I'm driving at here is we're in the middle of this rate cycle. Anytime we have had, I've said this months ago, we've had the conditions that we have now with the interest rates going the way they're going, we have always gone into a major recession, right? We've always done that. Now, that may not be the case this time. That may not happen. Of course, I don't know that for certain, okay? But I think it's important for us as investors and as traders to know this. Number one, as traders, we need to know that the Fed has a lot of power to affect the stock market, okay? Because they have a lot of power to affect the outlook that Wall Street has on the economy. So it's going to affect stocks in the short term. If we're not aware of that, we might be taking trades and then Fed news comes out and that can have it can release a lot of volatility, which can honestly sometimes just ruin an otherwise great trade, okay? So they've got 8 meetings every year. Sometimes they do more, but they've got 8 meetings every year. They do them on Tuesdays and Wednesdays. And Powell usually comes out, well, he always comes out and he gives a comment on Wednesday afternoon. And that's really when the volatility kicks in. So we need to know that for sure. If anybody is around the TradeWay program, they know we're always talking about Fed on Fed weeks, right? They've certainly dominated the news. But the longer term here, guys, is, well, we've got, and I'm going to say this one more time, we've got this great big bubble, right? That's my opinion. I think that's a lot of people's opinion, but certainly that's my opinion. And we're aggressively trying to slow things down because of inflation. And getting inflation from 7.5% down to the 6% it's at now, they're feeling like, well, that's really positive because it's headed the right direction. And that's all well and good. I think a lot of professionals and analysts will consider the next 2%, 1.5%, right? Not just 7 and 7 plus down to 6, but 6 down to 4, a lot harder to accomplish and so on because they want a target rate of 2%. That's historically what the Fed wants to do. 2% is the year over year inflation, right? They're okay with a target 2%. Anything above that is too high. So they're trying to get back down. So we've still got 4% to go. How much are they going to have to do? I think they've only said they're going to raise rates one more time this year because of the banks. Everybody was afraid. But I don't think that's going to deal with inflation. So watch for the Fed to actually turn tail on that and re-up, saying they're going to have to get more aggressive again. That would not surprise me, and the market will not like that. This market is very optimistic. And the reason I think this market is very optimistic is because jobs still hasn't really gone south. You guys have heard me say that on here if you've been on the program before. And, tech has primarily been where we're seeing the layoffs. Today, Disney announced a huge round of layoffs. I think we start to see that happen more and more throughout different places in the economy as this plays out. It's happened slower maybe than some thought it would, but we've got to watch through the rest of 2023. I told somebody earlier today, the S&P 500, the SPY is an instrument that just tracks the S&P 500. So investors can go out and buy the entire American economy essentially by buying the SPY. With the outlook we have on the economy right now, it'd be suspect to really go out and pick up a lot of the SPY if somebody didn't own it already, just because of these major downside risks. Again, there's no guarantees we don't go up from here because the American government can stimulate the stock market anytime they want, which brings me back to the visual I said I was going to show you guys. Let's just go down here for a second. Comparing the world's money and markets. Now, this is 2020, okay? So this isn't even fully up to date here, and I'm not going to show you the whole thing. I will put the link in the chat because it is actually completely fascinating to me. So you guys can see on the screen here, okay? The one little block there, okay? That, for the rest of this example I'm going to show you, that size square, okay, to that scale is worth $100 billion. So we're just doing a visual here on money, okay? That's worth $100 billion. Let's just scroll down for a second here, and I'm going to show you this. So that's the entire value of the world's silver, okay? Above ground silver, not below, above ground, okay? You can see crypto there and other 5,500 coins. There's a lot of coins. You see some notes on the left-hand side. Military spending, okay? U.S. budget deficit, that's for the fiscal year of 2020. So this isn't updated to 23, okay? So again, that square right there, 100 billion, okay? So there we go. Now, coins and banknotes. So this is physical money, okay? Tangible currency, not just on digital, right? Ledgers. This is actual physical currency. So there you go. There's all the world's money supply, at least of those major countries, I should say. Well, it's got an other here as well. Okay, now check this out. This is where we're going. I'll put the link in. You can look at the rest of it. It's absolutely incredible. But Fed's balance sheet, here's what I want you to notice. When the Fed comes in and does what they do in 2008, which, by the way, your tax dollars bailed out the banks for that, okay? When they came in 2008 and what they did in COVID. Okay, let's take a look at this. I want you to see this. This is the balance sheet. Added since, okay, I'm going to go down to here. So, guys, I wish there was a way I could just cover this with a square just so you couldn't see the one side for now. The black is the Fed's balance sheet, okay? Since it started up to 2008, just these 3 rows up to 2008. This purple was added since 2008, and the red is just since January 1st, 2020. Remember, this graphic was updated for 2020. So this is just 2020. Now, I want you to see this comment on the far right side. The Fed's balance sheet now sits at over $7 trillion. 40% of this total, 40% was only in 2022 alone. The amount of stimulant is what you're looking at here. Okay, from the beginning of the Fed. Now, remember, I told you 1913, almost 100 years of the Fed, and they've added 40% of the whole balance in the last, well, at that point, just a single year. We're looking back at 2020 now. Now, the thing that's got to land here is, well, wait a second. What does that mean for me? It means that we're sitting in a truly unprecedented scenario where, for my short-term people, right, trading short-term, we've got to be aware the federal funds rate, CPI, which is inflation, right? Because they're going to respond to the CPI reports. So whenever there's a CPI report, We need to know it. Okay. And any, Google Finance, CNBC, Google search, you'll be able to see the dates of the Fed and the CPI. CPI comes out every month. Okay. We just got CPI, or I'm sorry, you're going to get CPI for the previous month. Okay. So March, April, April will come in May and so on. So we've got to be aware of that, right? Not as key for making decisions in the moment for my long-term investors, right? Because you're not approaching your positions the same way as you would for a short-term trader, right? There are benefits to both, okay? Longer term, though, do we have the potential to see inflation continue to rise? If we do see inflation continue to rise, do we see the federal funds rate continue to go up? Did the Fed start tightening this policy too late? Right? Certain things are easier to stop early on. When you catch cancer early on, it's easier to deal with. Blair, are you saying this is an economic cancer? Well, that's an intense way to say it. But inflation, hyperinflation, yeah, that would be an economic cancer, right? It's eating away at the value of our money, our purchasing power, which, by the way, the US dollar has lost over 60% of its purchasing power since the year 2000. 60%. You can't buy with a dollar today what you could buy in the year 2000. That's because of inflation. And inflation is at a 40-year high, nearly. It's come down a bit, right? So this is pretty significant. If the Fed has to continue to battle that inflation because it's not coming down, they're going to keep raising the rates. If they keep raising the rates, we're going to keep seeing the squeeze as it works its way through the economy. And that is going to put pressure on the market if they don't feel confident. And that's going to mean the market continues to move down. Okay, now if the Fed stops and begins to lower the interest rate, honestly, a lot of Wall Street wants that. Wall Street wants to look at the market and think, it's going to keep moving up. Money's going to get cheap. Companies are going to get money that's going to be stimulated, and stocks are going to grow. Because when companies are growing, Wall Street's going to invest in stocks, and they're going to make great money in the market. That's what I'm trying to say, right? But that doesn't deal with inflation, right? And for the average American household and consumer, we've got to deal with inflation. That's the Fed's job at this point. So Wall Street may not get what they want. Now, Wall Street has ways to make money no matter what the market does, okay? But right now, they're committed to driving this thing higher. I can see that, right? The bulls are just not giving up. And again, my opinion is because I think we just really haven't seen a tip where things are really, for lack of a better term, just spinning out of control, right? There's some fear, there's some apprehension, but there's not panic. And I'm not saying I want panic. But when you get tipped into a real recession, you see things like the banks that happened the last few weeks, but it's pretty consistent, right? And we're starting to see the unemployment rate go up, which Powell had to testify to Congress. This was probably 2 weeks ago, a week ago, and he was being grilled. It was a committee. It wasn't really Congress. It was just to a committee. And that was one of the questions they had. How can you guarantee the American people that we're not going to see a massive spike in unemployment? Because that's what this can do when you trigger these interest rates going higher. So it is this economic talk. It's a little bit more fundamental data than we normally talk here on Market Monday. But I'm telling you, for individuals, somebody said here, Ruth said in the chat, I wish basic economics and market knowledge were taught in schools, because most folks have no idea. And here's what I tell people. If you're looking at something, you're looking at the S&P 500, and you want to have at least somewhat of a objective indicator as to the strength of what the market is likely to do over the next 6 to 12 months, look at what the Fed is doing, right? Look at what the Fed is doing. Is the Fed raising or lowering rates? Is it at zero? That doesn't guarantee a market direction in the next month. But over the long term, if they're having to be really aggressive, that's going to put pressure on stocks, okay? And we've seen that over the last year, okay? It is going sideways as they hold out to see, well, what is the effect of the Fed really going to be? And of course, we saw a drop on the banks, came and went pretty quickly. Keep seeing episodes like that, start seeing unemployment go up, I'll say for the last time, then we potentially see a bigger drop. If we do see a much bigger drop for you and I, it's going to mean tremendous opportunity, honestly. It certainly can be. It certainly can be because stocks get cheaper. The market gets cheaper. Okay. Now we don't know how that's going to play out. We don't know exactly what's going to happen. But markets coming down, for me, in my opinion, markets coming down, that means prices are coming down, right? And we move through that economic cycle again. And it's only to say that if somehow, some way, the S&P 500 just never recovers again, right, which has never happened, and they still have tools to turn tail and stimulate the economy like they've done every time, we definitely could see a tremendous opportunity there. So these are the kinds of things I want us to look out for and connect. The Fed isn't just about knowing economic information and history and government stuff. It's actually connected to the confidence and the projections of the market that help you and I make some good decisions about money that we have invested and money that we want to invest, right? And then obviously, like I said, on the short-term trading side, we really don't hold on to that long-term economic data. It's not as important. We just really want to know, when are they going to say something? When are they going to come on the microphone and say something? Because they could really jack up one of our trades if we're doing something and then they spin the market out of control in the short term, right? So that's something we want to keep in mind. Ruth says, will a bear ever happen during a time of confidence, or is that the rest we hear about during the bulls? So remember, a bull market has pullbacks, right? It has retracements and it has corrections. Okay, pullbacks are just a day or two of red. It's just pulling back a bit. If it's in a nice, beautiful uptrend, I'm going to show you right here. If it's in a nice, beautiful uptrend, I got to reshare that. I'm sorry. Right? Oops. Let me get rid of the volume there. I gotta, okay. Move that, right? It's going up, comes back down to the 20, up, back down, 10, 10, 10. So whatever, this is a weekly chart. So we could go to the daily chart and we'll see more actual fluctuation in the pattern. So the market comes up and down, right? It rolls up and down. It doesn't go up forever, okay? When it goes up, it's going to have pullbacks. That's a pullback right there, right? That's a pullback. It goes up, right? It retraces back down to the 20, okay? It retraces back down to the 50. But it also, let's go here. Right here, this isn't just a retracement. It retraced back to the 100-day here because you see it started hitting the 100, retraces back to the 100, back to the 100, breaks the 100. This is a correction, right? It actually corrects. Now, a correction, what's the word I'm looking for here, guys? Specifically defined, that's not the word I'm looking for, but we'll use that. Technically defined is 10% or more, right? It's dropped 10% or more. But a bear is 20% or more. Okay, so you're asking, will a bear ever happen during a time of confidence? Well, if you want to consider COVID a bear market, then there you go. That's a time when we did see a bear. And technically speaking, it dropped more than 20%. So that was technically a bear market. And that came during a time of pretty high economic confidence. It's not normal for the stock market to just turn just like that, right? You may have major events, something like September 11th, but that didn't trigger a bear market right there and then, although there really was a recession around that time when that tech bubble burst. What happens, you guys, is markets move in cycles. Money is cheap, companies are growing, things get really hot, and it grows to bubbles. Eventually, something happens and the bubble bursts. One of the things that tends to pop the bubble is the Fed raising interest rates, which is where you and I are at right now. So that's why this is actually really important. It's good for us just to know economics in general. Whenever, for the rest of our lives, we notice Fed's raising that federal funds rate, we can expect there's going to be some shifts in the economic season. It's just a simple way to look and not predict the future necessarily, but to say, oh, the season is changing. I won't always be able to say what the exact temperature is going to be tomorrow or next week, but I can definitely recognize when it's no longer spring and summer. I can definitely recognize when it's no longer fall and winter. And one of the ways I can do that is using the federal funds rate and what the Fed is doing. And that's why this is really important. Okay. So with that said, I appreciate you guys being on here, following along. Oh, I said I was going to put that in the chat and I didn't. So let me do that. I find it just fascinating. We may just spend a little time on Market Monday one night and just go through the whole thing. Because when you guys look at it, it's going to blow your mind. I think so. If you're interested in stuff like this, if you weren't, you probably wouldn't be here tonight. And I think you'll really enjoy looking at that. It's a very interesting graphic. And it certainly is telling about where we are, because as a country, I like to say it this way, and this is how I'll sign off tonight. I understand that federal economics is more complicated than the example I'm going to give. And yet that almost serves to prove the point I'm going to make even more. If my household puts all my bills on a credit card, or much of my bills, many of my bills, and thinks that somehow that solved the problem, it doesn't. Eventually, the bill comes in the mail. Right now, I think overstimulation from the Fed, too much patience with inflation while overstimulating, because they just kept doing it, that actually brought the bill in the mail, which is inflation. Inflation is the bill handed to Americans. And, politicians want to blame it all on COVID and, whatever party you guys ascribe to, I would imagine they would both probably use the same tactic. The reality is COVID itself didn't just create that. It was challenging. There's no question. That was unprecedented. But, I think we've been, the way I would say it is, crushing Red Bulls for a while now. And it's created a massive bubble in equities where things were so high. So high. And it's no wonder tech is seeing as the kind of layoffs they are, because they were growing as much or more than anybody while the world was just at home and all we did was used our computers, right? So it's definitely something that I find very interesting to see where this goes for the rest of the year. I think we could easily see, I don't think I will guarantee it, right? I'm not guaranteeing it, but I could easily see a much deeper decline in the indexes. And that's something I'll definitely be preparing and watching for in the months to come. And certainly one of the ways I'll do that is by watching the Fed. Thank you guys for being on here tonight. Market Monday. Of course, we'll be back next week. We'll keep diving into our Back to Basics series so that you guys know the things that we feel like y'all ought to know regarding your money, stocks, the economy, so that you're better prepared for the season ahead. And that's what we aim to do. Thank you to each one of you for being on here always. I appreciate you. Thank you so much. Have an amazing night, a great